So we had a very good performance. Exceptional returns were generated in the year 2023. In fact, 2023 was one of our best years compared to the last 2 years or so. In fact, the last time we had returns close to what we generated in 2023 was before the pandemic. So we actually generated a return for the Kenya Shilling Fund of 18.01%. This compares to 15.59 the year before, which is 2022. The dollar fund, on the other hand, returned 12.1%. Very difficult to compare with 2022 because we don't have a full year performance for 2022, but we feel that a 12.1% return on a dollar-based fund is actually a very good return as well. So we're very happy about the returns for Mansa for 2023, and even happier because it also marked our 5-year anniversary closure, which brought, specifically for the Kenya Shilling Fund, our average performance for the last 5 years to 17.4% net of fees. We believe that no other fund in Kenya has generated anything close to what we've been able to generate for the last 5 years, proving the fact that Mansa-X is an exceptional investment vehicle. So 2023, again, was a year that defied a lot of expectations. As market players around the world, we went into 2023 we were actually expecting a recession, especially in the US, mostly because there were very high concerns around the high levels of inflation and how central banks were going to deal with these inflationary numbers. So we expected that if we were going to have higher interest rates for a longer period, then this would create a recessionary economic environment. However, moving into 2023, the reverse actually happened. Yes, the Fed increased interest rates at the beginning of the year, but very quickly this actually ended up moderating inflationary numbers. So we went from inflationary numbers of 9.1% in the US, which was a 40-year high, to lows of 3%. And from that, the Fed actually now started demonstrating a little bit more confidence that they could actually reach their inflationary target of 2%. So for that reason, towards the end of last year, we now saw expectations that we might actually have a reversal of that concern that we'll have interest rates higher for longer to actually an environment where interest rates are actually reduced. So for that reason, market actually started pricing in that moving forward there'd be rate cuts. So the effect of this very quickly was stock markets started reacting very positively. Starting with technology stocks, which had taken a beating in 2022. We had seen the Nasdaq lose about 40% in 2022. In 2023, we saw the technology stocks, Nasdaq soar by 55%. The S&P again surged by about 25%. All these were phenomenal moves, and they were very much unexpected. Towards the end of the year, we also saw a very interesting phenomenon where for a very long time, the stock market has really been held by what you call the Magnificent Seven. So the Magnificent Seven tend to have an outperformance, a better return than most of the other stocks in the same index. So the Magnificent Seven include stocks like Apple, Microsoft, Amazon, Facebook, which is Meta, Alphabet, Nvidia. So those stocks typically tend to outperform other stocks, and their outperformance tends to then give the impression that the entire stock market is doing very well. So towards the end of last year, we now saw a more genuine, broad-based gain in Nasdaq and the S&P 500, where we saw smaller cap stocks actually start performing very well. That's a much healthier market, and it was very encouraging for equity investors. Looking at the bond market, expectations that the Fed will stop raising rates and might actually start cutting rates also led to a surge in bond prices. We saw a surge in the prices of bonds, especially in the longer term bonds. We're talking about the US 10s and the German bonds. We saw an outperformance in that. Again, this is an area that we're very keen on as Mansa-X. We really like to look at bonds, especially the long-term ones. Energy, again, this was an interesting area where we saw, we can look at crude if you look at crude prices, we saw prices in crude oil actually lose about 20% in value. This was mostly because the second largest economy in the world, which is China, there has been concerns about maybe the economy is not growing as quickly as expected. So in spite of OPEC cutting production, we still saw oil prices actually lose value during that period. So again, this is something we continue to monitor. Another interesting asset class in 2023 was gold. Finally, gold breached the $2,000 an ounce level, surging by almost 11.5% for 2023 alone. In fact, gold, strictly speaking, is one of the most interesting assets to have held for the last 15 years or so, and continues to be one of the assets that we really watch in our book. It was the only metal in 2023 that actually outperformed. The other one was copper, which only gained about 2%. So 2023, in summary, was a year where higher interest rates, the fear of higher interest rates as we moved into it suddenly became a non-issue. And in fact, after inflation was tamed, we saw markets rebound and give us a very nice platform to go into 2024. Locally, of course, the biggest conversation on the streets is the depreciation of the shilling. So we've had the shilling lose. In 2023, we saw it lose over 25% of value. And of course, this has really wiped out and eroded the purchasing power of most of our citizens. But fortunately for Mansa-X investors, and these questions, we've been asked this question before, has the loss of the value in the shilling actually boosted the returns for the Mansa-X Kenya Shilling Fund? Yes, it does. To some extent, because a lot of our investments are done in foreign currency. So naturally, when we look at the return of those asset classes, it's augmented by a factor, by the depreciation of the shilling, what you call a revaluation effect. So yes, we saw a factor of the Kenya Shilling loss improving the returns for our investments in the Mansa-X Kenya Shilling Fund. We also saw yields rising significantly. We saw yields rising towards the 18% level. Obviously, this is the effect of monetary policy as an attempt to rein in the weakness of the shilling, and we expect that this might continue for some time. You're reining in the shilling, you're also reining in inflation, so yields obviously then had to really aggressively be raised. The effect of this is also that the stock market took a thorough beating, because it then becomes very difficult to justify being invested in the NSE when you can get yields of up to 18% risk-free from the government. We also saw a flight of foreign investors from the local market, further exacerbating an already bad situation. So the NSE lost about 27% in value in 2023. Moving forward, it will be interesting to see how the effects of maybe foreign investors returning to markets and the shilling maybe stabilizing would affect the value of stock markets locally and the value of bonds moving forward. So for our top 10 holdings, and just even before I begin, it's important to note that we have actually put these top 10 holdings in the fact sheet. And as an investor, or if you really want to see our top 10 holdings, these are available on our fact sheets. You can find this online. And even if you reach out to our team, we can always share our fact sheet with you, where you can see the sort of assets that we invest in. Not only do we show you our top 10 holdings, we also show you the geographical distributions of these asset classes. So for both funds, one of our top 10 holdings was Eurobonds. So where we hold about a quarter of the fund in Eurobonds. There's been a lot of concern, obviously, from some investors wondering whether if governments default or if Eurobonds don't perform as we expect, is this going to have an effect on the fund? Well, it's very important to realize that we actually trade the mispricing of some of these Eurobonds. We feel that sometimes there's a lot of extreme negative sentiment of some of these Eurobonds. We're able to then trade those mispricings in these Eurobonds. That's actually predominantly how we make our money from trading these Eurobonds. And The second thing is also just to note that they're very well diversified. We are not in any one country's Eurobonds disproportionately. So we are very well spread out in the number of Eurobonds that we trade from different countries. It's also important to note that we did not invest in an Ethiopian Eurobond as well. So Eurobonds have continued to be a very good generator of return for the fund. For both funds, again, as I had mentioned earlier, we invest in German 10-year bonds and US 10-year bonds. Again, we've been asked by investors, how do you make a return from a paper that's yielding 3.8%, for example? It's important to note that what we trade is what you call capital gains in bonds. So if a bond is trading at 3.8, for example, the German bond was trading the US bond was trading at 3.8 and then the yield dropped to 3.25%. That's a significant price advantage for that particular bond. So when the yield of a bond drops, the price of that bond rises. So it's that movement that we actually trade. So we trade the prices of these bonds, not necessarily buying them to accrue the interest that is paid as coupon. So that's the strategy for both the Kenya Shilling Fund when we invested in the German 10-year bond, and the strategy in the dollar fund when we invested in the US 10-year bond. We also hold a lot of cash equivalents. In this case, we're actually talking about some local fixed income papers. An example is we participated in the most recent IFB, where we went into very good levels. So we're able to then capitalize on capital gains from buying these papers in the primary auction and selling them in the secondary market if we have to. The other thing that we traded heavily, of course, was the US dollar. Of course, the US dollar has been a big part of our book, where for a very long time, with aggressive tightening by the Fed, we've seen a stronger dollar. But towards the end of last year, we started now factoring the fact that the dollar would lose value. And it actually happened, because in the Q4 of 2023, the dollar lost almost 5% against a basket of currencies. Japanese yen is also one of the currencies we traded, especially in the Kenya Shilling Fund. And again, this demonstrates the fact that we're not always in one currency. So the Japanese yen is one of the assets we were holding. And we actually saw a movement of about 6% in value gain for the Japanese yen at the end of Q4 2023. Other asset classes that we were holding pharmaceutical stocks in the Kenya Shilling Fund, where we were holding Eli Lilly and Company. That's a pharmaceutical stock. And we were also holding Novo Nordisk, another pharmaceutical stock. That's in the dollar fund. Why are we holding these stocks? They actually own a patent for fat reducing drug, or rather obesity reducing drug, Ozempic and Wegovy. And we felt that this would really help these two companies to increase their earnings. And we actually saw Eli Lilly grow by about 8.5% in stock price in Q4 of 2023, and Novo Nordisk grew by a whopping 14% for that quarter alone. So we are continuing to be very bullish on these stocks. Now, towards the end of last year, we saw again geopolitical tensions become a conversation again, when Hamas invaded Israel, and then the retaliatory moves by Israel. So we actually invested in defense stocks. So we invested in Northrop Grumman, we invested in General Dynamics, and all these stocks gained by almost 20% in Q4 alone. This was actually one of the assets that actually really boosted the returns for the fund. We also invested in Amazon, which grew again almost 20% in the last quarter. So when it comes to commodities, we also invested in sugar. We've seen some investors asking how we invest in sugar. So sometimes we can be long sugar futures, or sometimes we can be short sugar futures. We were long sugar in Q3 of 2023, but at the end of last year, towards the end, we were actually long sugar, and we were short sugar, sorry, and we saw sugar lose almost 20% again in the Q4 of 2023. So those are our top 10 holdings, and it's important to note that if you look at the percentage holdings of those assets, the top 10 holdings don't add up to the entire fund, showing you just how well diversified Mansa-X is. I mean, we are talking about the top 10 holdings not having more than half the fund. So you can imagine the other half is held in other assets, totaling into almost 100 other assets. That demonstrates the diversity of this fund, which is one thing that we have to keep on reiterating to our investors, that we really try to have a very well diversified book where you have stocks, you have currencies, you have metals, you have commodities, and you have fixed income and so on. And this is also demonstrated geographically. We had positions in European markets, American markets, the Middle East and Asia, Oceania regions, and also the African region. So first quarter of 2024, of course, we have started 2024 with a lot of concerns around the geopolitical environment. So our biggest ongoing tensions have been what's going on between Russia and Ukraine. So that's an already ongoing conflict. What happened again towards the end of last year between Israel and Hamas, that again will continue disrupting tensions in the Middle East. And in fact, as we speak, we've seen a lot of disruption in terms of a transit through the Red Sea, where you've seen Houthi militants actually attacking ships. And what that does is create a lot of tensions around whether there'll be a disruption of the global supply chain. And if that happens, the effect of that on inflationary numbers. So as I mentioned earlier, one of the concerns for 2023 was inflation, and whether interest rates being used to manage this inflation were going to hurt the global economic performance. Now again, moving into 2024, it becomes a concern again because you have about 12% of global shipping going through the Red Sea. So if the ships have to go around a much longer route, what happens then? You can create inflationary pressures, especially on commodities. So we'll be really watching that moving forward into 2024, and inflationary numbers again become the main concern for 2024, and how we trade the central banks and how they react to any change in these numbers. Of course, it's also an election year. We recently saw Taiwan actually hold their elections, and they voted in a candidate, again, whom China does not really tolerate. We'll again see how this will escalate tensions there, considering this is happening at a time when economic performance in China is already at a much lower level than was actually anticipated after the pandemic. So we'll see how this plays out. We'll see the U.S. elections again, how that plays out. If we have if you have Joe Biden having to step down, and if Trump actually takes over in the U.S., it will be interesting to see how that again will affect markets in 2024. So, as was demonstrated in 2023, of course, it's not very easy to predict markets. And most of the times, all you can make are really just educated guesses. Markets seem to have a life of their own, but all we can do is react to markets based on what we anticipate. But we know for sure that interest rates will be a predominant conversation. How stock markets react to that, we'll be watching very closely. However, we still expect that we will probably be experiencing a lower interest rate environment. And a lower interest rate environment is more likely to boost stocks. We also expect that smaller cap stocks will actually now participate in higher in better stock market performance in 2024. We saw that at the end of 2023. We expect that to spill over into 2024. We also expect that companies might start having better earnings. Why? Because with lower interest rates, their ability to borrow at better interest rates will actually boost their numbers. So we expect better earnings numbers for most companies. We also expect bond markets to perform better. because lower interest rates will most likely lead us to better bond prices, especially for the developed market. Developed markets. For developing markets, we expect that interest rates might remain elevated for some time, because we are still grappling with inflationary pressures and local currency depreciation. If you have a lower interest rate environment and globally, small cap stocks are performing better, the effect of that is that you also have global fund managers becoming risk on, meaning that they become more aggressive because a lot of their stocks are actually performing better. The effect of that on our local stock market might be we might start seeing an inflow again of foreign investors back into our market, because the allocation of their portfolio to emerging market and frontier market stocks will actually increase. So we expect that this might actually boost our local stock market moving forward, and our currency by extension. We also have the Kenya 2024 Eurobond, which is maturing in June. As Mansa-X, we actually do not expect that the government is going to default on this paper. We actually expect that the government will make full payment on this bond. And we're also highly confident on most of the other Eurobonds that we hold, both Kenyan and other African countries. So moving into 2024, we still expect that this will be an interesting area to watch. We've seen yields in Eurobonds dip below the elevated levels they were at the end of 2022 and beginning of 2023. We expect that to happen at least for the first half of 2024, and will most likely be accelerated after the maturity of the Kenyan 2024 Eurobond in June. A dominant conversation right now globally is, of course, artificial intelligence, and it's become the one thing that is really driving a lot of stocks. If you look at the NVIDIA stock, we saw it hit an all-time high last year, purely because the demand for chips is very high as companies grapple to really make sure that they have AI as part of their means of doing business. So we expect this to continue to 2024. AI is something to watch. We'll be watching technology companies that incorporate AI in their systems, and we'll also be watching companies including educational companies, fintech companies that incorporate AI in their way of operating, because AI has the advantage of giving them the same results while still reducing the amount of human resource that they have to invest in. So that's something that we'll really be watching very closely in 2024, and we expect a lot of outperformance for chip makers like NVIDIA, Taiwan Semiconductor Company, and Qualcomm, and so on. So we'll be watching a lot of these companies in 2024. Finally, as a parting shot, we really want to thank our investors for believing in us, believing in Mansa-X, the Mansa-X dream. We've been running this fund for 5 years now, and during that period, we've grown to having an assets under management of 23 billion shillings. If you combine both our funds, the Kenyan shilling and the dollar fund, we find that this is something we would not have done if we did not have the belief from our clients, who have now grown to 12,000 clients in number. That's not something we take for granted. We understand the responsibility and the privilege that we've been given to be able to manage the investments of that many Kenyans, and we really appreciate it. We're very happy that for the 5 years that we have been in existence, we've been able to prove the concept of Mansa-X, which is a concept that a well-diversified portfolio, a portfolio that incorporates different asset classes, a portfolio that incorporates asset classes from many geographical regions, would tend to perform better than a portfolio that's only restricted to a very small number of asset classes and a very restricted geographical region. So for that reason, we saw Mansa-X actually return a net asset return of 17.4% on average for the last 5 years. That's something we're very proud of. As a portfolio manager, I want to assure the investors that it's something that we will continue to endeavor to do, which is to really be very careful with our investors' funds, meaning that we'll continue to be very careful about our downside risks while still trying to be diversified enough to give you that extra alpha return. Alpha return refers to the return above the risk that we are taking while we invest in the assets that we invest in. So moving forward into 2024, we continue to give our commitment to our investors, and we hope that the fund will continue to offer an above average return, and that we will also continue to grow in terms of the assets under management that we have. Thank you.